Here's something that should scare every investor. A company can report a massive profit and still run out of cash and collapse. It happens more often than you'd think. Profit is an opinion. Cash is a fact. And the only place you can verify that fact is one document most investors skip past: the cash flow statement. Today, I'm going to teach you how to actually read it. By the end of this video, you'll be able to open any company's financials, go straight to the cash flow statement, and know within 60 seconds whether the business is healthy or quietly bleeding. Let's get into it.
Welcome back to Behind the Numbers TV, the channel that breaks down financial statements in plain English. No finance degree required. Today's lesson is one of the most important in all of investing: how to read the cash flow statement. We'll cover what it actually is, why it matters more than the income statement in some ways, the 3 sections every cash flow statement is split into, the red flags that should make you suspicious, and a real numbers walkthrough so you can see it in action. If this is useful, subscribe and hit the bell. We publish a new breakdown every week. We'll start with the basics.
Number 1. Why profit can lie. Quick question for you. If a company sells 10 million naira worth of goods on credit, meaning the customer hasn't paid yet, is that revenue? Yes. Accounting rules say you record revenue the moment you make the sale, not when you get paid. So a company can look profitable on paper while customers are sitting on unpaid invoices for months. The profit is real in an accounting sense, but the cash isn't in the bank yet. That's the gap the cash flow statement exists to expose. Cash flow statement is a record of actual cash moving in and out of a business. No accounting assumptions, no estimates, just money that physically changed hands. And that is why professional investors always check cash flow before they trust a profit number. Number 2. Cash flow has 3 sections. Every cash flow statement for every company on Earth is split into exactly 3 sections. Once you understand these 3, you can read any cash flow statement in the world. Section 1. Operating activities. This is cash generated from the core day-to-day business, such as selling products, paying suppliers, paying staff. This is the most important number on the entire statement. If a company can't generate cash from its actual operations, nothing else matters. Section 2. Investing activities. This is cash spent on or received from long-term assets, like buying equipment, building a factory, acquiring another company, or selling off assets. Negative numbers here aren't automatically bad. A growing company should be spending on its future. Section 3. Financing activities. This is cash flow related to debt and shareholders, such as taking out loans, repaying loans, issuing shares, paying dividends, or buying back stock. This section tells you how a company funds itself and how it treats shareholders. Add all 3 together and you get the net change in cash for the period. That is the actual amount the company's bank balance moved up or down. Now, let's consider the most important of the 3, operating cash flow, or OCF. If you only have time to check one number, check this one. Here's the simple test every investor should run. Is operating cash flow higher than net profit or lower? If OCF is consistently higher than reported profit, that's a great sign. It usually means the company is collecting cash efficiently and isn't relying on accounting tricks to inflate earnings. If OCF is consistently lower than reported profit, that's a yellow flag. It can mean customers aren't paying on time, inventory is piling up, or in worse cases, the profit number is being managed aggressively. This brings us to free cash flow, the investor's favorite metric. This is the cash a company has left over after paying for the equipment, machinery, or infrastructure it needs just to keep running. It's called free because this is the cash management can actually choose what to do with. They can pay dividends, buy back shares, pay down debt, or reinvest in growth. Why does this matter so much? Because dividends are paid from cash, not from accounting profit. A company can report a profit and still be unable to pay a dividend if there's no free cash flow to support it. If you're investing for income, free cash flow is arguably more important than earnings per share, EPS.
So, what patterns should make you slow down and dig deeper? Negative operating cash flow for several periods in a row. A business that can't generate cash from its core operations is running on borrowed time, literally. A sudden cash flow spike driven by working capital, not sales. If operating cash flow jumps dramatically but revenue didn't grow at the same pace, check the notes. Sometimes the jump comes from collecting old unpaid invoices or delaying payments to suppliers. Both are one-time boosts, not repeatable performance. The company keeps raising new debt or issuing new shares just to fund dividends. If financing activities are propping up the cash balance every single year, that's not sustainable. That's a company borrowing from tomorrow to pay today. Investing cash outflows with nothing to show for it. Heavy spending on acquisitions or expansion is fine if it eventually shows up as higher operating cash flow down the line. If it never does, that money may have been poorly spent.
Now for a practical walkthrough, the way you should every time. Consider this cash flow statement. Operating cash flow is 680 billion naira, far higher than the 120 billion naira net profit. This is a good sign. But before I celebrate, I check why it is so much higher than profit. Was it real sales growth or a one-off working capital boost? That information is usually in the footnotes of the statement, and it's worth 5 minutes of reading. CapEx was 90 billion naira, leaving free cash flow of 590 billion naira, plenty to cover dividends and reinvestment. Financing activities were negative 60 billion naira, meaning the company paid down debt or returned cash to shareholders rather than borrowing more. That's shareholder-friendly. Add it all up, and cash on the balance sheet grew by 470 billion naira for the period. That's the entire skill. You're not doing complex math. You're asking the right questions in the right order.
Let's do a brief recap. The next time you open a cash flow statement, run through this in order. Is operating cash flow positive? Is operating cash flow higher than net profit? Is free cash flow positive after CapEx? Is the company funding dividends and buybacks from real cash or from new debt? Does heavy investing spend show up later as higher operating cash flow? If you can answer yes to most of these, you're looking at a business that's financially honest with its numbers, not just its press releases. Remember this: profit tells you a story. Cash flow tells you the truth. The next time someone shows you a glowing earnings headline, do what we just learned. Flip straight to the cash flow statement and check the numbers behind the number. That's how to read a cash flow statement, start to finish. If this helped you, hit subscribe. We break down a new financial concept and a new company's results every week on Behind the Numbers TV. Drop a comment. Which company's cash flow statement do you want me to break down next? Let me know below. This is Behind the Numbers TV. Every number tells a story. Now you know how to read it.